Welcome back, truth seekers, to another dive into the hidden currents of financial history. Today, we're unearthing a saga that began on Main Street, in the heart of countless American communities. For decades, savings and loan associations, or thrifts, were the bedrock of the American dream. They were simple, local institutions. You deposited your savings, and they lent that money out as low-risk mortgages, helping families buy their first homes and small businesses take root, a truly foundational pillar of post-war prosperity. These thrifts operated under a straightforward and, at the time, highly regulated model. They were designed to promote homeownership and local development, offering fixed-rate mortgages and paying modest interest on deposits. Federal Deposit Insurance, managed by the Federal Savings and Loan Insurance Corporation, or FSLIC, ensured that people's hard-earned savings were safe. It was a virtuous cycle, fueling a housing boom and providing financial stability to millions of ordinary Americans. But by the late 1970s, the economic landscape was shifting dramatically. High inflation and rising interest rates began to choke this dependable system. S&Ls were trapped, paying out high variable interest rates on customer deposits, but still holding on to vast portfolios of old, low-interest, fixed-rate mortgages. They were losing money on every single one, bleeding cash with every passing day. The very foundation of their business model was crumbling under relentless economic pressure. This predicament was known as a negative spread. Imagine buying a product for $10 and being forced to sell it for $5. That was the reality for thousands of thrifts. Their assets, those long-term, low-yield mortgages, were worth less and less, while their liabilities, the deposits on which they owed high interest, grew more expensive. It was an unsustainable situation, threatening to wipe out the entire industry. Regulators, initially slow to react, knew something drastic had to change. Desperate to save these institutions, a new philosophy began to gain traction: deregulation. The idea was simple yet radical. If S&Ls were failing because of restrictive rules, then freeing them from those rules would allow them to compete, innovate, and thrive once more. The argument was that greater freedom in investment options would enable them to generate higher returns, offsetting their losses and revitalizing their balance sheets. It sounded like a logical solution to a complex problem. In 1982, Congress passed the Garn-St Germain Depository Institutions Act, a landmark piece of legislation that dramatically reshaped the financial landscape. This act was designed to give S&Ls a lifeline, allowing them to diversify beyond traditional mortgages. They could now offer adjustable-rate mortgages, commercial loans, and even directly invest in real estate, stocks, and junk bonds. The handcuffs were off, and a new era of financial freedom, or perhaps recklessness, was about to begin. Crucially, the Garn-St Germain Act also raised the federal deposit insurance limit from $40,000 to $100,000 per account. This might seem like a minor detail, but its implications were profound. It meant that even if an S&L made incredibly risky bets, depositors were insured for a much larger sum. This removed much of the incentive for depositors to scrutinize their thrift's health, creating a dangerous moral hazard within the system. With these new freedoms, many S&L executives, often lacking experience in complex financial instruments, plunged headfirst into high-risk, high-reward ventures. The allure of quick profits was irresistible. Gone were the days of conservative, community-focused lending. Instead, money flowed into speculative real estate development, often in boomtowns like Texas and California, and into volatile corporate junk bonds. The goal was no longer safety, but maximum return, no matter the risk. The newfound ability to invest directly in real estate proved to be a particularly tempting and ultimately disastrous avenue. Thrifts began funding massive, often ill-conceived commercial projects: empty office parks, sprawling shopping malls in areas with no demand, and luxury condos that sat vacant. Developers, often with cozy ties to S&L executives, borrowed heavily, fueled by the promise of exponential growth. It was a speculative frenzy, divorced from economic realities. Beyond real estate, many S&Ls ventured into the burgeoning market for junk bonds, high-yield, high-risk corporate debt. investment bankers aggressively marketed these instruments, promising incredible returns. For thrifts desperate to climb out of their negative spread, these seemed like a magic bullet. The reality, of course, was that these bonds were incredibly volatile and often issued by companies on the brink, making them a ticking time bomb in an S&L's portfolio. To fund these increasingly ambitious and risky ventures, S&Ls turned to brokered deposits. Instead of relying on local savers, they paid brokers to find large deposits from institutional investors, often packaging them in $100,000 chunks to maximize federal insurance coverage. This allowed even technically insolvent thrifts to attract massive inflows of cash, effectively gambling with taxpayer-guaranteed money. The more they gambled, the more money they needed. As the S&Ls grew more complex and their investments more exotic, the regulatory agencies struggled to keep pace. The Federal Home Loan Bank Board, tasked with overseeing thrifts, was understaffed, underfunded, and often outmaneuvered by savvy, aggressive S&L operators. Political pressure, coupled with a belief in the power of free markets, led to a culture of lax enforcement and, in some cases, outright regulatory capture. The foxes were guarding the henhouse. The deregulated environment, coupled with weak oversight and the perverse incentives of deposit insurance, created fertile ground for widespread fraud. Some S&L owners and executives engaged in self-dealing, insider trading, and outright theft. They made loans to straw buyers, invested in their own shell companies, and inflated asset values. Billions of dollars were siphoned off, not through honest mistakes, but through deliberate criminal activity. The poster child for this era of excess and fraud was Charles Keating, chairman of Lincoln Savings and Loan. Keating famously used Lincoln to invest heavily in speculative real estate, junk bonds, and even his own businesses, enriching himself while placing depositors' funds at extreme risk. When regulators tried to intervene, Keating used political influence to thwart their efforts, illustrating the dangerous intersection of money and power. His story became synonymous with the crisis. The political dimensions of the scandal deepened with the Keating 5 controversy. 5 U.S. senators were accused of improperly intervening with federal regulators on behalf of Charles Keating. While ultimately cleared of criminal wrongdoing, the incident highlighted how political donations and influence could potentially compromise regulatory oversight, further eroding public trust in both financial institutions and government watchdogs. It was a stark wake-up call about systemic vulnerabilities. The speculative bubble couldn't last forever. By the mid-1980s, particularly in regions like Texas, the real estate market overheated and then crashed. Projects funded by S&Ls stood empty, their underlying collateral plummeting in value. Loans went bad, and the thrifts found themselves holding portfolios full of worthless assets. The high-risk bets that were supposed to save them now became a massive liability, exposing their deep insolvency. As more and more S&Ls became insolvent, the FSLIC, the Federal Insurance Fund, was overwhelmed. Designed to handle small, localized failures, it was never equipped for an industry-wide collapse. By 1987, the fund was officially bankrupt, with liabilities far exceeding its assets. This meant that the U.S. government, and by extension the American taxpayer, was now directly on the hook for billions of dollars in guaranteed deposits. The problem was no longer contained. The numbers were staggering. Between 1986 and 1989, over 500 S&Ls failed, with hundreds more teetering on the brink. Depositors lost confidence, creating runs on healthy institutions. The crisis was not just a handful of bad apples, it was a systemic meltdown of an entire segment of the financial industry. Thousands of jobs were lost, communities were impacted, and a deep scar was left on the nation's economic psyche. Faced with a catastrophic collapse and the risk of a wider financial contagion, the U.S. government had no choice but to intervene. In 1989, President George H.W. Bush signed the Financial Institutions Reform, Recovery, and Enforcement Act, or FIRREA. This comprehensive legislation was designed to clean up the mess, recapitalize the Deposit Insurance Fund, and restore confidence in the banking system. It was one of the largest financial bailouts in American history. FIRREA dissolved the bankrupt FSLIC, replacing it with the strengthened FDIC. It also created the Resolution Trust Corporation, or RTC, a new government agency tasked with managing and selling off the assets of failed thrifts. This massive undertaking involved liquidating hundreds of billions of dollars in real estate, loans, and other holdings. The total cost of the bailout ultimately soared to an estimated $160 billion, borne largely by American taxpayers. The Resolution Trust Corporation faced an unprecedented task, selling off a vast portfolio of seized assets, from empty office buildings to raw land, often at fire sale prices. This process, while necessary to recoup taxpayer money, flooded the market and further depressed real estate values in certain regions. It was a messy, complex, and politically charged operation, highlighting the sheer scale of the financial damage inflicted by the crisis. The S&L crisis profoundly reshaped the American banking industry. Thousands of thrifts either failed outright or were acquired by larger commercial banks, leading to massive consolidation. The distinct lines between different types of financial institutions began to blur. The traditional, local savings and loan, once a fixture of Main Street, largely faded into history, replaced by larger, more diversified financial entities. It marked the end of an era. Crucially, the crisis led to significantly stricter financial regulation and increased oversight. The lessons learned about moral hazard, the dangers of deregulation without adequate safeguards, and the potential for widespread fraud spurred lawmakers and regulators to implement new rules designed to prevent a similar catastrophe. Capital requirements were tightened, and risk management became a central focus for financial institutions. The savings and loan crisis served as a sobering preview of future financial instability. Many of the dynamics, from unchecked speculation and moral hazard to regulatory failures and massive government bailouts, would echo in the dot-com bust of the early 2000s and most starkly in the global financial crisis of 2008. It was a dress rehearsal for the challenges to come, a stark warning unheeded by some. Today, the ghost of the S&L crisis still lingers on Main Street. It reminds us of a time when the pursuit of profit eclipsed prudent lending, when deregulation turned into a free-for-all, and when the safety net of deposit insurance created unintended consequences. The crisis was a painful, expensive lesson that a robust financial system requires not just innovation and freedom, but also careful oversight, accountability, and a healthy respect for risk.